Hey everybody. Dividend stocks have always been a favorite among long-term investors because they provide two benefits: steady income and potential capital appreciation. In 2025, with interest rates still in flux and the market adapting to new economic realities, certain dividend-paying companies stand out as solid buy-and-hold opportunities. That said, let's dive into the top 6 dividend stocks that I think are great buys right now. One of the most reliable sectors for dividends is consumer staples. And there's one company that leads the pack: Procter & Gamble. P&G is a household name known for its wide range of everyday products, from Pampers, diapers, to Tide laundry detergent and Oral-B toothbrushes. But what truly sets it apart is its impressive dividend history. For over 6 decades, P&G has increased its dividend every year. It's making it a dividend king. That means the company has raised its dividend for at least 50 consecutive years. Now, you might be wondering why such a long streak matters. Well, it shows the company's commitment to rewarding shareholders and their confidence in their ability to keep doing so in the future. This kind of reliability is hard to find. But P&G's strength doesn't stop at its dividend. The company boasts a strong balance sheet and a diversified product line. This means they can weather economic storms like recessions or inflation, which is crucial for any stock you plan to hold long-term. See, people will always need essential products. So P&G's revenue remains relatively stable, even when the economy isn't doing so hot. Plus, they have a global reach, so they're not dependent on a single market. The only downside to consider with P&G is that its growth might not be as flashy as some other companies. Consumer staples businesses tend to grow at a slower pace because, well, once you've got a product that works, you don't change it much. But for those of us looking for steady, reliable growth and income, that's exactly what we want. We'd rather have our investments steadily climb over time than take big, risky leaps that could end up being nothing but a roller coaster ride. So if you're re-looking for a safe investment that will be a solid part of your portfolio for years to come, consider P&G. Its reputation, track record, and stability make it a top choice for any serious investor. Our next pick is Johnson & Johnson. While facing some restructuring due to its baby talc powder lawsuits and evolving business segments, Johnson & Johnson remains a giant in the healthcare industry. Known for its iconic brands like Tylenol, Band-Aid, and Listerine, Johnson & Johnson J&J has a diversified product portfolio that caters to various healthcare needs. This wide range of offerings provides stability, ensuring that the company's revenue isn't overly reliant on a single product or market segment. In fact, this diversification is one of the primary reasons for J&J's remarkable resilience over the years. Now, what really makes J&J stand out is its dividend. The company has increased its dividend for over 60 years, earning it a spot in the exclusive group of dividend kings. It's rare for a company to maintain such a long dividend growth streak, but J&J has done it consistently. And what's even more impressive is the company's balance sheet. Despite recent challenges, J&J maintains a strong financial position with low debt and a substantial amount of cash reserves. This financial strength gives them the ability to continue investing in research and development, marketing and acquisitions, all of which support their long-term growth and, importantly, their dividend payments. Looking ahead, Johnson & Johnson's future looks promising. The pharmaceuticals and medical devices segments are expected to drive growth, while the company continues to invest in emerging markets. Plus, they're actively pursuing new technologies and innovative treatments. These efforts are not only expanding their customer base, but also enhancing their product offerings and solidifying their position in the market. So if you're seeking a stable, reliable investment with a solid dividend, Johnson & Johnson is a top choice. Just keep in mind that while the stock may not offer the highest dividend yield on the market, its consistent growth and strong financials make it a compelling option for long-term investors. Now let's shift our focus to the energy sector with Chevron. Chevron is a major player in the oil and gas industry. But what truly makes it stand out is its generous dividend yield. Currently, the stock offers a dividend yield of around 3.7%, which is significantly higher than the S&P 500 average. What's more, Chevron has a history of increasing its dividend, having raised its payout for 9 consecutive years. This consistent dividend growth reflects the company's commitment to rewarding shareholders and their confidence in their ability to generate sustainable profits. But how does Chevron's dividend compare to its peers? Well, it's worth noting that Chevron has one of the highest dividend yields in the oil and gas sector. This is mainly due to the company's strong cash flows and disciplined approach to capital spending. Chevron focuses on maximizing shareholder value by returning a significant portion of its profits back to investors through dividends and share repurchases. Looking ahead, Chevron's future looks bright. The global demand for energy is expected to rise in the coming years, and Chevron is well positioned to benefit from this trend. The company is investing heavily in renewable energy sources such as wind and solar, as well as exploring opportunities in liquefied natural gas, which is in high demand globally. These investments are not only diversifying Chevron's revenue streams, but also positioning them for long-term growth. So if you're interested in adding some energy exposure to your portfolio, Chevron is an excellent choice. Its high dividend yield, strong financials, and commitment to renewable energy make it a top contender in the oil and gas sector. Next on the list is Microsoft. When it comes to technology stocks, you might think of fast-growing companies with sky-high valuations. But what if I told you there is a tech giant that also rewards its shareholders with a growing dividend? Enter Microsoft. Yes, the company behind Windows, Office, and Azure is not just a powerhouse in the tech world, but also a dividend king. For nearly 2 decades, Microsoft has increased its dividend annually, demonstrating its commitment to providing investors with consistent returns. But why does a tech company prioritize dividends? Well, Microsoft's massive revenue from recurring sources such as cloud services, Office subscriptions, and server products contribute significantly to its ability to pay and grow its dividend. These sources of revenue provide a stable, predictable income stream that allows the company to reward shareholders while still investing in research and development. Looking ahead, Microsoft's future looks promising. The company is benefiting from the widespread adoption of its cloud computing platform, Azure, and the growing demand for its software and services. Additionally, Microsoft's foray into artificial intelligence, or AI, is opening up new revenue streams and enhancing its existing products. The integration of AI into its operating system, Office suite, and cloud services is giving Microsoft a competitive edge. It's driving innovation and boosting its bottom line. So if you're looking for a tech stock that offers both growth and income potential, Microsoft is a compelling choice. Strong financials, commitment to dividends, and investment in AI make it a top contender in the tech industry. Another great choice is JP Morgan Chase. JP Morgan is a leading global financial services company offering a wide range of services from investment banking to asset management and retail banking. But what truly makes it stand out is its consistent performance and its commitment to rewarding shareholders. JP Morgan has a history of raising its dividend, having increased its payout for 11 consecutive years. This track record of dividend growth demonstrates the company's financial strength and confidence in its ability to generate sustainable profits. Moreover, JP Morgan's revenue is diversified across various segments, which helps to mitigate risks and ensure stability. The company's investment banking and trading activities generate revenue from fees and commissions, while its asset management and retail banking segments bring in revenue from interest on loans and other financial services. This diversification ensures that JP Morgan is not overly reliant on any single source of income. Looking ahead, JP Morgan's future looks bright. The company is benefiting from rising interest rates, which boost its net interest income, and from its strong position in the market. JP Morgan is known for its expertise in mergers and acquisitions, which are expected to rebound after a slowdown in recent years. Additionally, the company's focus on digital innovation is enhancing its products and services, improving efficiency, and attracting new customers. So if you're looking for a financial stock with a strong dividend and a solid track record, JP Morgan is an excellent choice. Its diversified revenue, commitment to dividend growth, and focus on innovation make it a top performer in the industry. Last but certainly not least is NextEra Energy. NextEra Energy is a leading provider of clean and renewable energy. And while energy companies aren't typically known for their commitment to shareholders, NextEra bucks that trend. In fact, the company has increased its dividend for 28 consecutive years, making it a dividend king in the utilities sector. What's more, NextEra has a history of strong financial performance. Thanks to its focus on renewable energy sources such as solar and wind, these sources are not only environmentally friendly, but also cost-effective, helping Nextera to keep its prices competitive while still turning a profit. Additionally, Nextera has a diversified customer base across Florida and other parts of the United States. This diversification ensures that the company is not overly reliant on any single geographic area, providing stability to its revenue stream. Looking ahead, Nextera's future looks very promising. The global shift towards renewable energy sources is expected to accelerate in the coming years, and Nextera is well positioned to benefit from this trend. The company is investing heavily in research and development, exploring new technologies, and expanding its reach into new markets. This forward-thinking approach ensures that Nextera remains at the forefront of the industry and drives its long-term growth. So if you're looking for a utility stock with a solid dividend and a commitment to sustainability, Nextera Energy is an excellent choice. In conclusion, there are plenty of solid dividend stocks out there that are worth considering for your 2025 portfolio. Remember, look for companies with strong fundamentals, a history of dividend growth, and a bright future ahead of them. And don't forget to diversify your investments across different sectors to reduce risk and maximize your returns. Investing in a range of high-quality dividend stocks can help you build a well-rounded portfolio that's capable of weathering any market conditions. And don't forget to stay informed and keep an eye on your investments. Do you have any dividend stocks that you're excited about for 2025? Feel free to share your thoughts below. And if you enjoyed this video, please hit the like button and subscribe for more insightful content. Thanks for watching.